Let's take a deeper dive into markets. I want to bring in Deiya Pernas, co-founder of Pernas Research. Deiya, it's great to have you on the show. We had last talked in the first quarter. Today is the first day of the second quarter. How's your view on markets changed?
Hi, thanks for having me again. We think there's considerable amount of room for optimism as we go forward through the rest of the year. Clearly, the markets ran up roughly 30% in the last 5 months, which is substantial. We expect some pullback at some point. Some point the market will take a breather, but we are pretty optimistic. The consumer's doing well, the economy's doing well, and although we've had some noisy inflation data, we think inflation is moderating.
Interesting. So how long do you think this rally can last?
We think, given some of the trends, especially in AI, some of the trends in reshoring, as long as earnings continue to show momentum, which they have to start the quarter, if that can continue, we see that this rally can have room to go, although at some point you should see some slight retracement.
Interesting. Talk to me more about AI, because NVIDIA and artificial intelligence, some of these chip stocks really have fueled the markets. Certainly the NASDAQ in 2023 with that index at 42%. The NASDAQ still up in the first quarter, I think with the gain of 1.8%, not performing as well as the Dow and the S&P, but coming off those very strong gains in 2023. Do you think that these AI stocks can outperform after what's been such a strong performance thus far?
You continue to see many tens and hundreds of billion dollars pouring into AI. Really, it's AI compute. All that money is going into GPUs and the data infrastructure that surrounds GPUs. So there's still significant amounts of spend going into that area, and we see clearly an NVIDIA or Supermicro, any companies that is levered to these data center type trends will continue to show earnings momentum. At some point, budgets will have to rebalance. You're seeing corporate budgets rebalancing away from traditional type of tech spend to more AI. Companies haven't necessarily increased IT budgets yet, but that could be another leg to this trend.
Interesting. Now, if you were an investor or advising your clients, Deiya, what would you tell them? Where should they be adding to their allocations as we start the second quarter?
I think there's a few areas that we like. Obviously, we've talked about AI a ton. We like AI a lot. We like renewables. We think that trend will continue. If you look at our electric grid, significant amount of strain is going to be put on that, not only from increased EV penetration, but also the amount of data infrastructure that is growing, that is using up energy needs, is going to go up from about 2% of energy needs, and that's going to get to about 4 to 5% in the next couple of years. So that adds significant strain to our already strained electrical grid. And companies that can take away strain from that electrical grid, renewable companies, something like an Enphase that has these microinverters and can translate solar energy to electric energy and creates a sort of decentralized grid where homeowners can sell electric energy to each other, I think is poised to benefit significantly. And so renewables is something we like. Another sector we typically go to sectors where there's a lot of volatility. So many people might run away from large sell downs in different sectors, but we usually see it as opportunity. And where you're kind of seeing some polarization with some big winners and some big losers, where you're seeing that kind of dispersion within a sector right now, is consumer discretionary. You have a lot of apparel stocks that have done well. A lot of them have done poorly. A lot of luxury stocks have done poorly as a result of the Asia-Pacific slowdown. So there's some great dispersion in some sectors we like and some long-term trends in some sectors that we really like.
I was going to ask, in terms of the recommendations you're giving us, are they long-term plays or in some cases short-term trades?
Generally, we focus on more long-term trades. If we're trying to focus on short-term trades, we would look at maybe some other type of sectors, like, for example, a short-term trade. If you look at gun stocks, if you look at maybe something like a Smith & Wesson, it's done remarkably well and should probably continue to do well with polarization, with the election cycle coming up. But when I'm talking about renewables, AI, or some of these good apparel names that have been sold off significantly, those are more intermediate type plays. We're looking at holding periods of longer than a year, for about a year to 3 years.
There's been so much talk about this so-called soft landing. Can the Fed engineer a soft landing without catapulting the economy into a recession? What's your take?
I think the Fed has done a remarkable job so far. They've clearly said they were going to be data dependent. So if the data shows something contrary to what their strategy is, they're willing to adjust. And the economy so far has remained remarkably resilient. You look at unemployment rates. Unemployment rates are still very low. Inflation has been noisy, but it is trending in the right direction. We are big believers in the disinflation trend. If you look at the money supply, that's moderating. If you look at the velocity of money, that's also inflected downward. So if you have those two trends that are both moderating, it's very difficult, unless we get some sort of cost push inflation from supply shocks, it's very difficult to see a situation where inflation would be sustained. So we think the Fed's done a great job, and the economy looks great, and we think it's going to continue to do well. So in my book, they get an A+.
Okay, so it sounds like, per your take, Deiya, that the U.S. would avoid a recession, and rate cuts, when they come from the Fed, might be to get to more of a normalized state. Is that the case?
I think that's very well said. And at the end of the day, there is an element to recessions that is unpredictable. You can look at all the backward-looking data you want, but if animal spirits all of a sudden go the other way around, and business owners and consumers are afraid to transact, you can get a very quick reversion, and you can go into a recession. You saw that. Obviously, COVID was an example of that, a very extreme example of that, and that was only a couple-month-long recession. But if animal spirits turn, it could render all sorts of predictions totally useless. But currently, right now, things look constructive, and we believe we're cautiously optimistic that the economy will continue to perform well along with the broader market.
Mm-hmm. Okay, so you would add to equity allocations. It seems like at these levels, Deiya, anything that investors need to be aware about? Of course, there's always the risk of the animal spirits, as you were just talking through, but bouts of volatility that we might see this year, even a presidential election. What would you tell our viewers in the event that we do run into some volatility in 2024?
I think that volatility, historically, if you look at volatility from election cycles, it tends to be a lot of noise. There tends to be very little correlation between which type, whether a red candidate or a blue candidate gets elected, and subsequent market returns. So I think very little energy should go into trying to predict that and predict subsequent market reaction. And if investors are looking for something that I think is a risk, it's really, I think, the fragmentation of the broader global economy. If you've seen one point of softness this year, it's been global trade. Many economies are subsidizing, they're going through a cycle of industrial policy where they're subsidizing their own sectors and their own companies. And there's a lot of protectionism there. You see more tit for tat tariffs. And I think that if that cycle continues, you could get some sort of fragmentation that puts a damper on globalization, global trade flows, capital trade flows, a lot of these mechanisms that are really responsible for the global growth that we've seen. So if any of that starts to continue in that trend, I would think that that's the biggest risk to markets. Markets like free trade, markets like markets like countries and companies working together in a free sort of way. So that's what I would say is the biggest risk.
All right, Deiya Pernas, co-founder of Pernas Research. Deiya, great to have you, especially as we start the second quarter and the NASDAQ still gaining ground.